Everyone watches the Fed. But this week, it wasn't the Fed that moved markets. It was Japan's bond strategy and a challenging U.S. Treasury auction. If you want to understand bond yields, don't just follow interest rate hikes. You need to follow the auctions. Here's the key difference. The Federal Reserve sets the overnight rate, the cost of short-term borrowing. But Treasury yields, especially on long-term bonds, are set by supply and demand in the market. And the clearest window into that? The auction. Every week, the U.S. Treasury announces how much debt it wants to issue. Investors show up to bid, and the more they want it, the lower the yield they accept. If demand is strong, yields fall. If demand is weak, yields rise. This is where the market decides how risky it thinks U.S. debt really is. Now, here's something many miss. Countries run their bond markets differently. Japan prefers longer-term bonds, 20, 30, even 40 years, often held by domestic insurers, banks, and individual investors. The U.S. leans more on shorter-term issuance, like 2- and 10-year notes, and most treasuries are held by foreign governments, mutual funds, and pensions. Different strategies, different risks, different reactions when things shift. On May 21st, the U.S. held a 20-year Treasury auction, and it didn't go well. To get buyers, the Treasury had to offer a higher-than-expected yield of 5.047%, a sign of weak demand. That triggered a ripple effect across the entire bond market. Here's why that matters. When a 20-year bond auction clears at a higher yield, it doesn't just affect the new bonds being sold. It reprices the entire secondary market, because older 20-year bonds now look less attractive by comparison. Every pension fund, insurer, and asset manager holding those bonds has to mark them down immediately at market value. And even a 5 basis point increase in yield, just 0.05%, can cause a roughly 0.75% to 0.85% drop in market value for a typical 20-year U.S. Treasury. On large portfolios, that's millions in paper losses, triggered by one auction. Then came Japan. Japan's own 20-year bond auction just recorded its weakest demand since 2012, with the bid-to-cover ratio falling to 2.5. That poor result sent long-dated Japanese bond yields soaring and sparked fears of market instability. In response, Japan's Ministry of Finance signaled it may cut issuance of super-long bonds. That reassured investors, and yields began to fall again. And here's where the global link kicks in. As Japanese yields settled and long bonds became harder to find, investors began looking elsewhere, especially toward U.S. Treasuries. That renewed demand helped stabilize the U.S. long end just after its auction shock. This is how interconnected global bond markets really are. So next time you hear yields jumped, don't just assume it's the Fed. It could be a weak auction. It could be a signal from Japan. It could be the quiet, overlooked mechanics that actually set the cost of debt. If you want to understand what really moves markets, not just what's in the headlines, subscribe for more global breakdowns every week. Because even the safest market in the world is still ruled by one thing: demand.